Everything you've been told about protecting your savings is designed to make you lose. I know that sounds paranoid, extreme, maybe even conspiratorial. But hear me out. You've been taught the responsible path. Save in a bank account, maybe buy some bonds. Diversify into a 401k with index funds. Trust the Federal Reserve to maintain price stability. Listen to financial advisors who tell you 2% inflation is healthy. Meanwhile, your savings lose 20% of their purchasing power in 3 years. The house you could have afforded in 2020 now costs 40% more. Your retirement account might show bigger numbers, but buys less than it did 5 years ago. And you're told this is normal, natural, just how markets work. Ludwig von Mises would call this exactly what it is: systematic theft through monetary manipulation. Here's the shocking truth Mises proved mathematically in 1912. Over a century ago, the very institutions you trust to protect your savings are the ones engineering their destruction, not through conspiracy, but through the inevitable logic of fiat currency and central banking. The Federal Reserve isn't failing to control inflation. Inflation is their business model. The boom-bust cycle isn't a natural disaster they're trying to prevent. It's a predictable result of the very policies they implement. You know something's wrong. You feel it every time you see your grocery bill, every time you calculate how many more years you need to work, every time you wonder if your kids will ever afford a home. You're not imagining it. You're experiencing what Mises called the crack-up boom, the terminal phase of a monetary system based on ever-increasing credit expansion. The good news? Mises didn't just diagnose the disease. He gave you the framework to protect yourself, not with hot stock tips or get-rich-quick schemes, with understanding so deep that you'll see through every lie, every manipulation, every false promise from institutions that profit from your ignorance. This isn't theoretical economics. This is financial survival based on the clearest economic thinking of the 20th century. You're not paranoid for feeling something's deeply broken in our financial system. You're observant. Mises started exactly where you are, watching his life savings evaporate in the 1920s Vienna hyperinflation, while experts assured everyone it was temporary. What you're about to discover is a complete framework Mises developed to understand how central banks systematically transfer wealth from savers to governments and debtors. More importantly, you'll learn the specific principles for protecting your wealth that emerge from that understanding. I'm not going to tell you what to buy. I'm going to teach you how to think about money, inflation, and saving so clearly that you'll never be fooled again by institutional narratives designed to keep you confused and poor. If you want to discover more about how great thinkers like Mises can transform your understanding of economics and protect your financial future, subscribe to this channel, where we explore ideas that the establishment doesn't want you to understand clearly. Before Mises can teach you how to protect your savings, you need to understand what money actually is. And I mean really understand it, not the fairy tales you learned in school. You know what fascinates me most about this? Every economics textbook tells you money is a medium of exchange, store of value, and unit of account. True enough, but they leave out the one thing that matters most. Money is the most marketable commodity. That's Mises' revolutionary insight from 1912. Money didn't emerge because governments declared it. It emerged because people trading goods discovered that certain commodities, gold, silver, salt, were easier to trade than others. A fisherman didn't need to find someone who wanted fish and had exactly what he needed. He could trade fish for gold, then gold for anything. Notice how this works in reality. Money arises spontaneously from people trying to solve the problem of coincidence of wants. Nobody invented it. Nobody decreed it. It emerged from millions of individual decisions about what holds value reliably. Let me show you something amazing. Every successful money in history shared specific characteristics. Durability, it doesn't rot. Divisibility, you can make change. Portability, you can transport value. Fungibility, one unit equals another. And most critically, scarcity. Limited supply is what makes something valuable as money. Here's the brutal truth. Modern fiat currency violates the fundamental nature of money. It's created infinitely by central banks. It's not scarce, it's abundant by design. The Federal Reserve can create trillions with keystrokes. Imagine this scene for a moment. Mises in 1912 Vienna, watching the Austro-Hungarian bank expand credit to fund government spending. He understood something nobody else saw. When you break the connection between money and scarcity, you don't create prosperity. You create a ticking time bomb. The story gets darker. In 1922, when Weimar Germany was printing money to pay war reparations, Mises published Stabilization of the Monetary Unit, warning that this would end in catastrophic hyperinflation. The experts dismissed him. Modern monetary management is sophisticated. They assured everyone, we have controls. 2 years later, Germans were using wheelbarrows of cash to buy bread. Mises' colleagues who had mocked him lost everything. He had converted his savings to hard assets and survived. That's not ancient history. That's the pattern repeating right now. When the Fed created $4 trillion in 2020 to 2021, they weren't saving the economy. They were doing exactly what Mises warned about, expanding the money supply far beyond productivity increases. The inflation you're experiencing now isn't a surprise. It's the inevitable result Mises predicted would happen every single time. You know why your dollar buys less? Because there are exponentially more dollars chasing roughly the same amount of goods. That's not corporate greed or supply chain disruptions. Those are symptoms. The cause is monetary expansion. The key insight Mises had, and you need to internalize, is this: fiat currency isn't a neutral medium of exchange. It's a mechanism for transferring wealth from people who save, that's you, to people who create money, that's government, and people who borrow first, banks, corporations, the already wealthy. Every time the Fed prints money, they're not creating wealth. They're diluting your savings. It's the same as if you own shares in a company and they issued millions of new shares without your consent. Your percentage of ownership just decreased. That's what inflation really is. Not rising prices. That's the symptom. Inflation is the expansion of the money supply. Rising prices are how the market adjusts to more money chasing the same goods. Here comes the really interesting part. Once you understand this, you realize that the safe savings vehicles you've been told to trust, bank accounts, bonds, even treasury bills, are mathematically guaranteed to lose value in a fiat system. They pay interest below the real inflation rate. You're getting poorer by being responsible. Now that you understand what money is, let me show you the mechanism that repeatedly wipes out savings and why it's not accidental. Mises called it the Austrian business cycle theory, and it explains every financial crisis you've lived through: the dot-com bubble, the 2008 housing crash, the 2020 everything bubble. Here's how it works. The Federal Reserve wants to stimulate the economy, so they lower interest rates below the natural market rate. This is crucial. They're not discovering the price of money. They're artificially setting it. What happens when you make borrowing artificially cheap? Businesses undertake projects that only make sense with cheap credit. Real estate developers build condos that require sustained low rates to be profitable. Tech startups with no revenue raise billions because money is free. Home buyers stretch to afford houses because mortgages are cheap. Imagine this scene. It's 2005. The Fed has kept rates at 1%. Banks are lending to anyone with a pulse. Housing prices soar because cheap credit creates artificial demand. Construction booms. Everyone feels wealthy. Your neighbor quits his job to flip houses. This is what Mises called the boom phase. It feels like prosperity. Jobs everywhere. Rising asset prices. Optimism. Financial advisors tell you it's a new paradigm. This time is different. But here's what Mises understood that the optimists missed. This boom is built on sand. The projects being funded don't reflect real consumer preferences. They reflect distorted price signals from manipulated interest rates. You know what fascinates me most about this? Mises could predict a crash without knowing which specific sector would collapse. He didn't need to know it would be housing in 2008 or tech in 2000. He just needed to know that artificially cheap credit was creating malinvestment, investment in projects that couldn't survive normal interest rates. Think about your own experience. How many businesses boomed during 2020 to 2021 that are struggling now? How many friends got into crypto or meme stocks because money is free? How many companies hired aggressively only to lay off thousands this year? That's not bad luck. That's the inevitable correction Mises described. Here's where it gets personal for your savings. During the boom, your conservative savings in cash or bonds look stupid. Your risk-taking neighbor who leveraged into real estate or stocks looks like a genius. Asset prices inflate faster than your savings grow. The pressure to join the party is immense. Financial advisors tell you you're missing out. You feel left behind. So maybe you move some savings into the booming assets. Try and catch up. Then the crash comes. The Fed, seeing inflation which they created, raises rates. Suddenly projects that needed cheap credit can't survive. Businesses fail. Layoffs begin. Asset prices collapse. And your neighbor who looked like a genius is now bankrupt. Notice how this works. The boom seduces you out of safety into risk. The bust punishes you for taking that risk. Either way, savers get destroyed. Let me tell you a true story from Mises' life. In the 1920s, he advised the Austrian government to stop credit expansion and accept a short, painful correction. They ignored him, kept expanding credit, and created a bubble that burst far more catastrophically. He wrote, "There is no means of avoiding the final collapse of a boom brought about by credit expansion." That's not pessimism. That's physics. Artificial booms create real busts. The only question is when and how severe. If this framework is clarifying financial patterns you've lived through but never understood, hit that like button so more people can discover this analysis. And comment below which boom-bust cycle hit you hardest. Let's share experiences. The cruel genius of this system is that it rewards debtors and punishes savers. When the Fed creates inflation during the boom, people who borrowed heavily see their debt become easier to pay with cheaper dollars. Meanwhile, your savings in nominal dollars buy less. During the bust, asset prices collapse but debts remain, so the leverage get crushed. But if you stayed in cash safely, inflation during the boom already eroded your purchasing power. Heads they win, tails you lose. That's the boom-bust cycle Mises described, and it's engineered into a fiat central banking system. Here's where Mises' analysis gets really uncomfortable. Everything financial advisors tell you about safe savings is based on the assumption that the monetary system is stable. Mises proved it's inherently unstable. You think your bank account is safe? Let's examine what's actually happening to your money. When you deposit $10,000 in the bank, you think it's sitting there safely, earning a little interest. But banks operate on fractional reserve. They only keep about 10% of deposits as reserves. The other 90% they lend out. So your $10,000 becomes $9,000 in loans to borrowers. But here's the insane part. That $9,000 gets deposited in another bank, which keeps 10% and lends out $8,100, which gets deposited and lent again. From your original $10,000 deposit, the banking system creates roughly $90,000 in money supply. Notice the problem? Most money in the system doesn't actually exist. It's claims on money that can't all be redeemed simultaneously. That's why bank runs are catastrophic. Because the money isn't really there. Mises called this fiduciary media. Money substitutes backed by faith rather than assets. And he showed mathematically that this system requires continuous credit expansion to avoid collapse. If banks stop lending and expanding credit, the whole pyramid contracts. Here comes the really interesting part. The interest rate your bank pays you, maybe 0.5% or even 3% in today's higher rate environment, is always below real inflation. Always by design. Why? Because banks borrow from you at low rates and lend at higher rates. That's their profit model. But the Fed sets the baseline rates artificially low to keep the boom going. So you're guaranteed to lose purchasing power. Let me show you something amazing. From 1971, when Nixon ended gold convertibility, to 2024, the dollar has lost about 87% of its purchasing power. So $10,000 in 1971 would need to be $77,000 today to have the same buying power if you kept that $10,000 in a savings account. Even with compound interest, you'd have maybe $15,000 to $20,000 nominal dollars. But in real purchasing power, you'd have lost massively. That's not market forces. That's systematic wealth transfer through monetary debasement. Now, let's talk about bonds, supposedly the safest investment. Government bonds are promises to pay you back dollars in the future, plus interest. But who's making that promise? The same government that can print infinite dollars to pay you back. When you buy treasury bonds, you're lending to an entity that can devalue its debt by inflating the currency. Imagine lending your neighbor $1,000, and he pays you back with $1,000 in monopoly money he printed. Technically, he paid you back. That's what governments do with bonds when they inflate. Mises witnessed this firsthand in post-World War I Europe. Governments financed war debt by selling bonds to patriotic citizens, then inflated the currency to make the debt easier to pay. Bondholders were wiped out. They followed all the safe advice and lost everything. You know why this matters right now? Because the US government has $34 trillion in debt. There are only two ways to handle that: default, which is politically impossible, or inflate it away, which is politically easy. If you're holding treasury bonds expecting them to be safe, you're volunteering to be the one who pays for government debt through inflation. The government gets to spend money now, and your bonds become worth less in real terms. Even corporate bonds face the same problem. The interest rates are set in a market distorted by Fed policy. Real inflation exceeds the yield. You're losing purchasing power while thinking you're being prudent. That story from Mises' life keeps haunting me. His colleagues who saved in bonds and bank accounts, following all responsible advice, lost everything in the 1920s inflation. Mises, who understood monetary theory, protected his wealth. The difference wasn't luck. It was understanding. The traditional safe havens, cash, bonds, savings accounts, are safe in nominal terms. You'll get your dollars back, but those dollars buy less and less every year. You're not losing money. You're losing wealth, and that distinction is everything. Now here's what you actually came for. How do you protect your savings using Mises' framework? First, understand that Mises won't give you an investment strategy. He gives you something better, a framework for evaluating what holds value when currencies don't. The core Misesian principle is this. In a fiat money system, you must distinguish between money, what government declares, and real wealth, what actually holds value. Real wealth means goods and assets that have use value independent of government decree. Things people will want regardless of what currency they're using. Things that can't be infinitely created. Let me be absolutely clear. I'm not giving financial advice. I'm teaching you how to think through Mises' lens so you can make your own informed decisions. Here's Mises' hierarchy of monetary quality. Tier 1, sound money. Historically gold and silver. Limited supply. Can't be created by governments. Maintain purchasing power across centuries. Mises held gold through multiple currency collapses. Tier 2, hard assets with real use value. Productive land, quality real estate in growing areas. Businesses that produce actual goods, commodities with industrial use. Things with intrinsic demand beyond monetary speculation. Tier 3, claims on productive assets. Stocks in companies with real earnings, not speculation, but understanding these are still denominated in devaluing currency. You're hoping returns exceed real inflation. Tier 4, fiat currency and bonds, what you need for transactions and short-term liquidity, but systematically lose value in an inflationary environment. Notice the pattern? Mises would tell you to hold the minimum necessary in Tier 4 for daily life and shift wealth up the tiers toward things that hold real value. Now, the sophisticated objection. But gold doesn't pay dividends or interest. It just sits there. Mises would respond, exactly. It sits there maintaining purchasing power while your dollars evaporate. The point isn't to get rich. It's to preserve wealth across monetary disruptions. Think about what happened in every hyperinflation. Weimar Germany, Zimbabwe, Venezuela, Argentina. People with savings in local currency were wiped out. People with gold, land, or businesses that produced actual goods survived. You're not preparing for hyperinflation necessarily, though Mises warns it's the end stage of unchecked fiat systems. You're preparing for the steady erosion that's definitely happening. Let me show you the practical application. Suppose you have $50,000 in savings. Traditional advice says keep it in high-yield savings account or short-term bonds. You get maybe 4% interest. You feel responsible. Mises would ask, what's real inflation? Not the CPI, which systematically understates it, but actual increase in money supply and prices of things you buy. Probably 7 to 10% annually the past few years. So your 4% return is actually a 3 to 6% real loss annually. In 10 years, your $50,000 has maybe $60,000 nominal value, but perhaps $35,000 real purchasing power. You followed all the rules and lost 30% of your wealth. The Misesian approach would be keep maybe $10,000 in cash for emergencies and liquidity. That's your tier 4, necessary but depreciating. Consider moving significant portion to tier 1, sound money metals, as long-term wealth preservation, not speculation, preservation. Another portion to tier 2, maybe productive real estate or a small business, or tools and equipment that produce income, things that generate real value regardless of currency. Maybe some tier 3, carefully selected stocks and companies with real earnings, real products, pricing power in an inflationary environment. Wait, you might be thinking, this sounds like just diversification advice. No, traditional diversification is about spreading risk across asset classes. The Misesian framework is about understanding which assets preserve wealth when the monetary system is designed to transfer it away from you. Traditional advice assumes the dollar is stable and you're optimizing returns. Mises assumes the dollar is systematically devaluing and you're defending purchasing power. That's a completely different game with completely different rules. Here's the story that crystallizes this. In 1913, you could buy a quality men's suit for $20 gold, about 1 ounce. Today, 1 ounce of gold, roughly $2,000, still buys a quality men's suit. The gold maintained purchasing power. The dollars evaporated. That's not investment advice. That's monetary reality. Here's what nobody tells you about protecting your savings. The hardest part isn't the strategy. It's the psychological warfare against you. Mises understood something profound. Inflationary monetary systems require keeping savers confused, fearful, and compliant. Because if everyone understood what was happening and acted rationally to protect themselves, the system would collapse. So you face enormous pressure from institutions, media, financial advisors, even friends, to keep playing a game that's designed to make you lose. Let me show you how this works in practice. When you start converting savings to gold or hard assets, you'll hear, gold is a barbarous relic. It doesn't earn returns. You're being paranoid. Just trust the system. These aren't arguments. They're social pressure to keep you compliant. Notice how financial media treats people who distrust fiat currency. They're doomers, gold bugs, conspiracy theorists. The language is designed to make prudent wealth preservation seem crazy. But here's what Mises would point out. In 1920s Germany, people who distrusted the mark and converted to hard assets were called paranoid, until they were the only ones who survived with wealth intact. The pattern repeats. Dismiss skeptics as crazy until events prove them right. Then memory hold the whole thing and start over. You know why this matters right now. Because we're in the phase where questioning monetary stability makes you sound crazy. The Fed has tools. The dollar is backed by the full faith and credit. Modern monetary theory has evolved. These are the same assurances given before every monetary collapse in history. Mises heard them all and warned that confidence in fiat currency is the last thing to go before collapse. Now, the emotional manipulation gets intense. If you don't invest in stocks, you'll miss the growth. Cash is trash. You have to take risks to build wealth. This is gaslighting. They're calling prudent wealth preservation fear and reckless speculation responsible investing. Mises would tell you, in a sound money system, saving should be the responsible choice. The fact that it isn't in our system tells you everything about our system. Think about the genius of this manipulation. They convince you that losing 7% purchasing power annually to inflation while gaining 10% in stock prices, netting 3% real, is winning. Meanwhile, someone who preserved purchasing power in sound money is losing because there's no nominal gain. They've made you grateful for treading water. Let me tell you about the loneliest part of following Misesian thinking. You'll watch others get rich, on paper, in the boom. Your conservative approach will look stupid for years. The social pressure to abandon sound thinking and chase returns is immense. Mises lived this. Through the 1920s boom, colleagues mocked his warnings. Through the 1950s to 60s Keynesian dominance, he was marginalized. He died in 1973, seemingly vindicated only posthumously by the 1970 stagflation that proved his theories. The psychological cost of being right early is watching others prosper from being wrong temporarily. But here's the powerful truth. When inevitable correction comes, and Mises proved it must come, those who preserved will survive and thrive. Those who chase paper gains get destroyed. Your job isn't to maximize returns during the boom. It's to survive the boom and the bust with purchasing power intact. This requires psychological strength. You need to, first, detach from social proof. Just because everyone's doing it doesn't make it wise. Mises was often a minority of one. Second, think in real terms, not nominal. $1 million that buys what $100,000 bought before isn't wealth, it's inflation. Third, accept opportunity cost. You might miss some boom gains. That's the price of not being destroyed in the bust. Fourth, maintain conviction through mockery. People will think you're paranoid until events prove you were prudent. Fifth, remember you're playing a different game, not maximizing returns, preserving purchasing power across monetary disruption. The institutions want you scared of missing out, scared of being left behind, scared of not trusting experts. Mises would tell you, be more scared of trusting institutions whose incentives are opposite to yours. Your government wants to devalue debt through inflation. Your bank wants you as a cheap source of capital. Your financial advisor earns fees on transactions. Nobody's incentive is protecting your purchasing power except you. That's not cynicism. That's Misesian realism. Everything you believed about protecting your savings, bank accounts, bonds, conservative diversification was designed for a world that doesn't exist anymore. A world where money was sound, institutions were trustworthy, and saving was actually rewarded. Mises doesn't destroy that illusion to make you hopeless. He destroys it to set you free. The revelation here is simple but profound. You're not failing to build wealth because you lack financial sophistication. You're losing purchasing power because the monetary system is designed to transfer wealth from savers to governments, banks, and early borrowers. Once you see the mechanism Mises explained, credit expansion creating booms, inevitable busts, systematic currency debasement, you can't unsee it. Every financial news story, every Fed announcement, every expert reassurance becomes transparent. When they say the economy is strong, you hear the boom we created with fake credit is still going. When they say inflation is transitory, you hear we're hoping you don't realize we're debasing the currency. When they say diversify your portfolio, you hear spread your losses across multiple depreciating assets. You now see the game. And seeing the game changes everything. This isn't just intellectual knowledge. This is a difference between being systematically impoverished by institutions that smile while robbing you and consciously preserving the wealth you worked for. Mises lived through the complete destruction of the Austrian currency. He watched colleagues who trusted the system lose everything. He watched his own mother, who kept savings in government bonds out of patriotism, become nearly destitute. The pain of that experience drove his life's work. He gave you the framework not from theory, but from watching monetary collapse destroy good people who trusted bad systems. Now you stand at the same crossroads. Trust institutions whose incentives oppose yours, or understand the monetary reality Mises mapped with mathematical precision. The choice is yours, but now it's an informed choice. You're not a victim of mysterious market forces anymore. You're a conscious actor in a system you understand. That understanding is the first and most crucial form of wealth preservation, because they can debase currency, but they can't debase your understanding. And once you understand, they lose their power over you. Starting today, when you face financial decisions, where to keep savings, whether to take on debt, which assets to buy, you'll ask different questions. Not what will maximize returns, but what preserves purchasing power across monetary disruption. Not what are experts recommending, but what are the incentives of people giving this advice? Not what's the safe conventional choice, but what would survive if the monetary system became unstable. You don't need to become perfect at this immediately. Mises himself admitted making mistakes. The goal isn't perfection. It's thinking clearly instead of being manipulated. This week, do this. Calculate your real purchasing power change over the past 3 years. Not what your account balances show, but what those dollars actually buy now versus then. Housing, food, energy, healthcare, that's your real return. Probably negative despite all your responsible saving. Now evaluate your saving strategy through Misesian lens. How much is in Tier 4, fiat currency and bonds, losing purchasing power annually? How much is in Tier 1 to 2, sound money and hard assets, preserving wealth? You don't need to change everything overnight, but you need to start thinking in these terms instead of the conventional framework designed to keep you compliant and poor. In 6 months, when the next financial crisis hits, and Mises prove it will, you won't panic. You'll recognize it as the inevitable correction of malinvestment. You'll understand why it's happening, and you'll have positioned yourself to preserve wealth through the disruption. The confidence that comes from understanding cannot be overstated. When others panic because they don't comprehend what's happening, you'll be calm because Mises already explained it a century ago. That's the real wealth, not just preserved purchasing power, but intellectual clarity that no one can debase. There's a line from Mises I can't forget. There is no means of avoiding the final collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as the result of voluntary abandonment of further credit expansion, or later as a final and total catastrophe of the currency system involved. Do you feel the weight of that truth? Do you recognize how it changes everything about how you think about your savings? Mises isn't offering you comfort. He's offering you reality. And in that reality lies your power to act. Imagine your life 2 years from now after applying these principles. You won't be perfectly protected. No one is. But you'll understand what's happening when the next crisis hits. You'll have positioned significant wealth in assets that preserve purchasing power. You'll watch the panic with calm understanding instead of confused fear. When financial media scrambles to explain why unexpected inflation or crashes occurred, you'll remember that Mises explained the mechanism in 1912. When politicians promise solutions that are actually the cause of the problem, you'll see through it immediately. When friends ask what's happened to the economy, you'll be able to explain it clearly. This channel exists to discover together the wisdom of thinkers like Mises, people who saw through institutional lies the fundamental truths that protect you in chaotic times. Subscribe if you want to continue building this framework. In the next video, we'll explore how Mises' business cycle theory predicts the next major financial crisis and the specific warning signs you can watch for right now. See you there. And meanwhile, may sound thinking preserve your wealth when unsound money destroys for others.